All right, let's just jump right in. For the past few years, the investment game felt pretty simple, right? Buy tech, buy AI stocks, and just watch them climb. But as we're looking ahead to 2026, the rulebook for building wealth is getting a massive rewrite. And today, we're going to break down exactly why the smart money is starting to talk less about saving stocks and a whole lot more about saving bonds.
I mean, seriously, if you rode that AI stock wave, hats off to you. It's been an absolutely incredible run. But now, you might be looking around at the market and just get this feeling that, well, everything seems kind of expensive. So the huge question on everyone's mind is, what's the next move? Where do you put your money to work when all the obvious plays feel a little crowded, maybe even a little risky?
And this really gets to the heart of what this explainer is all about. The whole economic landscape of 2026 is just fundamentally different from what we've all gotten used to. That whole period of nearly zero interest rates, that easy money that just fueled this massive growth, yeah, that's over. We are now heading into a totally new phase where the focus isn't just on growth at any cost. It's about quality, it's about stable returns.
So that brings us right to our first big topic, the glorious return of bonds. And look, this is not your grandfather's boring old bond market. We are talking about a brand new macroeconomic reality that is making fixed income one of the most compelling places to be. Let's dig into the data.
Okay, so take a look at these numbers. What's really fascinating here isn't just one data point, it's the story they tell together. We're looking at global growth that's, well, it's steady. Not exactly shooting for the moon, but solid, around 3.2%. And then there's inflation. It's cooling off for sure, but it's proving to be a bit stubborn, kind of sticking around that 2.8% mark. So what happens when you mix decent growth with sticky inflation? You get a situation where central banks are probably going to say, you know what, let's just hold rates steady for a while. And that is the perfect setup for bond investors.
And this range right here, this is the magic number for 2026. This is where forecasters see the U.S. Federal Reserve's neutral interest rate landing. So the really crucial point is this. The whole cycle of crazy, aggressive rate hikes is done. And we're not expecting to go back to zero anytime soon. Rates are finding a new, stable home at a much higher level, and that changes the entire game for anyone looking for income.
So with interest rates settling down, what does that actually mean for your portfolio? It means you can now get yields that look like this, 4.8%. That's the current all-in yield you can find on high-quality, investment-grade corporate bonds. For the first time in more than a decade, you can earn a really attractive, really steady income from some of the safest companies on the planet. This turns bonds into a core engine for your returns, not just some defensive afterthought.
Okay, now if you're thinking bonds are just for, slow, old economy companies, you need to think again. The bond market is seeing this huge new trend, and it's being driven by the most dynamic companies in the world. So let's find out who's behind this pretty surprising shift.
Yep, you're seeing that right. The very same tech giants that have been powering the stock market, we're talking Meta, Alphabet, Oracle, are now issuing record-breaking amounts of bonds. And why are they doing it? They need billions, literally billions, to fund the AI revolution. Building data centers, locking down power, buying up all the chips they can find. This creates a brilliant new opportunity. You can now help fund the future of AI, not by taking on all the stock market risk, but by literally lending money directly to these titans of industry.
This quote just sums up the unique power of this moment perfectly. I mean, stop and think about that risk-reward balance for a second. You basically get to be the bank for the world's most profitable companies while they build the next wave of technology. And for doing that, you get a predictable, almost 5% annual return, with an incredibly low risk that they won't be able to pay you back. It's a total game changer.
But, and this is a big but, not all bonds are created equal. This new world of higher interest rates is creating this huge divide in the corporate world. We're calling it the K-shaped survival game, a world where quality is absolutely everything. This is where you have to be really smart about where you put your money.
And this slide just lays out that split perfectly. On one side of the K, you've got the high-quality companies. Their bonds are stable, and they're attracting a flood of investment money. But on the other side, you've got the lower-quality, CCC-rated companies, and they are in some serious trouble. They are super vulnerable to these higher rates, and their risk of going bankrupt is definitely climbing. So, why is this happening? Let's look at the mechanism that's driving it. It's called the refinancing wall, and it's as intimidating as it sounds. We're talking about a massive wave, over $600 billion of corporate debt that's all coming due in the next couple of years. Now, this debt was taken out back when money was cheap, almost free. Now, these weaker companies have to go out and replace it with new loans,
only this time at much, much higher interest rates. For a lot of them, that extra cost is going to be the final nail in the coffin.
And this number is the direct result of that wall. The projected default rate for these speculative, lower-quality bonds is expected to hit 3.8% in 2026. Now, that number might not sound massive on its own, but it represents a huge jump in risk. It's a clear warning sign for investors to prioritize quality and make sure you don't get caught on the wrong side of that K-shaped market.
Okay, so we've covered the new reality, the huge opportunity in high-quality debt, and the big risks you need to avoid. Now, let's get practical. Let's make this actionable. We're going to walk through 3 different playbooks, each tailored to a different kind of investor.
First up, the conservative investor. If your number one goal is to protect your capital and just generate a reliable, steady income stream, then your 2026 playbook is going to be heavily weighted towards bonds, maybe an 80-20 split. The core of your strategy here is to use tools like ETFs. Those are exchange-traded funds that hold a big basket of the highest-grade corporate bonds. This lets you lock in those safe, juicy yields we were talking about without you having to go out and pick individual bonds yourself.
All right, next, the balanced investor. You still want a piece of that stock market action, that growth potential, but you want to cushion the ride with the stability of income. In this case, a 50-50 portfolio makes a ton of sense. The real strategy here is pairing your high-growth AI stocks with funds that hold select, investment-grade corporate bonds. It creates this powerful blend of offense and defense in your portfolio.
And finally, for the aggressive investor, you're looking to beat the market. Your portfolio is still mostly stocks, maybe 70%. But your bond allocation here is super strategic. You're not just playing defense. You're using things like actively managed high-yield funds, where a pro manager is trying to hunt for those rare, undervalued opportunities, finding companies that have been unfairly beaten down while carefully avoiding the ones about to crash into that refinancing wall.
Now, just a quick word of caution. I know this formula looks incredibly intimidating. Don't worry, you don't need to do the math. It's just here to illustrate one simple but really crucial point about managing risk. The longer the term of your bond, the more its price can swing up or down if interest rates do something unexpected. It's exactly why a lot of pros right now are focusing on medium-term bonds. They give you a great yield without taking on quite so much interest rate risk.
So let's wrap all this up with the 3 key takeaways for 2026. Number 1, bonds are not just a boring backup plan anymore. They are a core engine for generating income. Number 2, quality is everything. It is non-negotiable. You have to steer clear of those weak companies about to hit the refinancing wall. And finally, number 3, stay flexible. The world can change fast, so keep a close eye on what policymakers are doing and be ready to adapt. So the playbook for building wealth has definitely changed. The strategies that worked like a charm for the last decade might not be the ones that win in the next. The real question is, armed with all this information, are you ready to adapt and play the new game?